Sonthalia joins us now. And Manish, I'm asking this question without getting into the reasons why we are. The question is, what should one do? Time to buy fear or time to protect capital?
Because I think the markets are likely to fall further, and this depends on whatever we are seeing in Ukraine. So, how much of a fall can happen? I think if we have a Crimea type incursion, not a full-fledged war, then markets can fall 5% from the current levels. If we have a full-fledged war, invasion of Ukraine, where nobody wants that sort of a situation, not even the Russians want that sort of a situation. We are likely to see a 10% downside. So India is a buy story, it's a given, but what happens is this whole geopolitical tensions are overreacted upon by the markets. We have seen all of that during the Gulf War also, where markets actually fell 15-20% and then rose above the pre-Gulf War levels within a period of 6 months. So in geopolitical tensions, markets do overreact, and this time around, it is going to get manifested in higher commodity prices, flight away from risk assets, and depreciating currencies. All of that will mean that there is more pain on the downside. So keep your watches ready, to be able to buy at lower levels from where we are today. So my sense is we are going to fall further before rising again, but we will rise.
Managers normally follow what is called as a fully invested strategy, at least at Motilal Oswal, that's what I understand. So, how are you approaching this fall? One side, there is temptation to buy because there is going to be a sentimental rub-off which is impacting an Indian hotel to an idea, from an oil company to a pharma company. But if you don't have cash, would you be forced to churn?
No, so we choose our sectors very carefully, and I think we are leaning on three sectors primarily, four sectors so to speak. BFSI, we think the fundamentals and the stock prices are deviating significantly, and sooner or later this will fall in line. There's not too much of an impact on the Russian banking system, or is it going to impact Indian financials with that? I don't think so. Then is technology, which is oblivious of what's happening, out here in the tension region out here. So that's again one sector which is somewhat waterproof. And pharmaceuticals, where all the negatives are there in the price. Automobiles, where everything negative is in the price. So how are we approaching is that while we remain fully invested, we reach out to investors to say that this is a godsend opportunity. It's an overreaction in the market. If you have deployable cash, if you have stayed, out of the market still now, if one was to invest at current levels, then the next 1 year, 2 year returns are going to be very favorable because you are going to buy the favored sectors at much lower prices than what should be volatile.
That's one part of the story. The other part of the story also is what is it that you completely avoid in the market? So, what are those spaces right now that you would completely steer clear of?
See, as I said, that this geopolitical tension will manifest itself on the negative side in the form of higher commodity prices. In Q3 numbers, also we saw for the broader markets as a whole, margin headwinds was all pervasive. And with rising commodity prices, and particularly if you're importing a lot of those commodities, those sectors would get impacted much more. As it is, corporate India will have to meander through margin headwinds over the next 2 quarters. And the situation is not getting any better. So I think, sectors where imported raw materials are used and that to global commodities on a very large scale, those are going to get impacted very, very severely. And whether we talk about our favored sectors, in the case of pharmaceuticals, the supply side shortages. Now this whole thing will again disrupt shipping and containers and all of that. So we have to meander through them. Or let's say in the case of white goods, consumer durable, consumer discretionary as a whole, material cost pressures have yet not been fully passed. And now we are looking at this sort of a situation. So, well, high inflation, interest rates have to be dealt with in conjunction with the geopolitical tension. I think it is a pick and choose, where companies who are able to pass on higher raw material cost in the form of higher prices would be outperforming those sectors which are not in a position to, pass on these costs. So sectors which comes to my mind currently, which is going to get impacted very severely, is the cement space. Prices are not moving up, and third quarter numbers showed immense raw material cost headwinds. It was expected those cost headwinds would be there in Q4, but now the situation looks quite alarming. It may trickle down into higher margin pressures even going into quarter one and quarter two. While volume growth assumptions are good at around 8 to 9% for fiscal 23, but it would not translate into any sort of growth in profits. Valuations may compress. I mean, this raw material cost headwind will be there across the corporate sector, and that is why pricing power in individual companies is what will matter.
Manish, to add to what's happening on the geopolitical front, and with Brent now spiraling up to $100 to a barrel this morning, there's also a very big internal event, and that's the LIC IPO. Do you think that correlation and bearing on the market is only going to indicate a weaker market in the days to come, more than what we are doing, aligning ourselves to the globe? Because it's a sizable IPO, it's sure to suck a lot of liquidity out of the market as it is.
No, so this whole conundrum about big IPO sucking out liquidity is not entirely true. From the simple point of view, is that SIP flows are extremely strong, and these are all domestic flows. Mutual fund, it will translate into mutual fund buying, and LIC itself has a huge deployable corpus in the form of equity buying every year. So even though we have record outflows coming from the FII front and more can come, I think there's ample firepower for domestic liquidity to support the markets when there's clear case of emergence of value in the market. See, last 2 years, the markets have been extremely frothy. The mid-cap segment of the market, small-cap segment of the market, which generally traded at discount to your large caps, they were trading at almost about premium, and even as we speak, these valuations are broadly in line with the large cap valuations at around 18, 19 times FY23 numbers. So if there were excessive build on the positive side over the last 1.5 years, these are self-correcting measures. Ukraine-Russia tension is just one of the reasons. So I think, we really should not get overtly worried about this whole overreaction in the markets due to geopolitical tensions. We should be looking to buy and buy at lower levels. So where there, the margin of safety, the valuations will become much more reasonable. As it is, markets are not very frothy, and domestic liquidity is enough. I mean, we should not really get too worried about FI outflows, etc. That's a part of the whole churn. So I am really not worried about LIC IPO getting or taking out a lot of liquidity. But yes, the primary market will cool off significantly. The amount of exuberance that we saw in the primary market is all gone. The new age internet companies, etc., trading at 30 times sales, 40 times sales, all of that is history. I mean, that cannot happen. And that will mean more rationality prevailing in the markets where profits are going to be valued much more reasonably. And that's the way things are. I mean, nothing to be quite alarmed about the LIC IPO.